Welcome back to F.A.C.E. Jim Carroll at VIXologist.
Good morning, Coach.
Okay,
Hey,
that was funny. That I had to laugh for that one. That was good.
Anyway, every guy's favorite doctor. Anyway, buddy, what do you see setting up here in VIX? To me, it looks like I don't know the plumbing like you do, but
Oh man,
technically a close over 20 would look pretty good.
yeah. So the plumbing has only gotten more complicated, and to be honest, I don't think with zero DTE and CBO coming out with a VIX 1 day, I don't think anybody really knows what's going on. But I guess in the land of the blind, the one-eyed man is king, right, Coach?
Yeah. So so what are you telling people about the VIX and hedges? So I don't understand this 1 day option trading either.
So can I share my screen?
Oh yeah, sure. Try it now.
Okay. Let's see if there we go. Can you see it?
Yeah, coming up. Okay, got it.
Got me?
Yep.
Okay, so let's move along. Oh, hang on. There we go. So let's just start out with a little overview year to date. What's been happening in volatility land using the SIBO term structure, which some people like, some people don't like. I like it because these are all constant maturity measures of implied volatility. And I haven't stuck 1 day on here yet because the historical data set isn't quite yet complete. But if you look at the middle line, the blue year to date, doesn't look really terribly interesting. VIX has stayed below that magic 20 line. We got a little excited in the middle of March. And then, last month we saw the lows, the futures term structure has generally been in contango, right? Which is a tailwind for a short vol trade. And as nervous as everybody has been, what's been working so far this year is just that. It has been short volatility.
Yeah. Except for that spike, Jim.
Yeah, you had the spike right around the the first whiff of the Silicon Valley Bank signature bank problem, the regional bank problem, which remains an overhang on this market, as you guys were talking about.
It was hard to get paid in VIX calls because I remember last time you were on, I said I bought those June 25s. And
if you blinked,
I got out that day. You know why? They weren't even paying intrinsic value.
Yeah.
We're trading at 31, and the best offer was like at 475. They weren't even putting that 1 1/4 intrinsic with all that time.
Yeah.
Left on the option. What kind of card game is this anyway, man?
Well, let's go around the table.
Talk about a stacked deck. I mean, you're right, and they won't pay you.
Let's go around the table. You got Slim, you got Tex, you got Shady.
Yeah.
It's a tough card game. It's been a repeat of last year so far, where you just didn't get paid to be long VIX or long volatility. And notwithstanding all the stuff that's going on, we remain in that mode, and it's driving people crazy. The one, if we wander off to, what is this zero DTE thing? What's this 1 day VIX thing? The one thing that I've been keeping an eye on. So, you know, the futures term structure really hasn't flirted with serious backwardation so far this year. But, you know, if you look at VIX 9-day, right, which has been around for quite a while, going back to 2011, and how often has that 9-day implied volatility been higher than the 30-day implied volatility, right? How often have people been more nervous about the 9-day outlook than they have been about the 30-day outlook? And, you know, so far this year, and I'm comparing year to date for 2023 against full years, you know, in priors, you know, we're already up close to 50% of the days with VIX 9-day higher than VIX itself. And there are, I think, are two messages in there. One, there is a lot of activity in the shorter tenor options complex, 0 DTE being part of that, but obviously VIX 9-day does not take 0 DTE into the calculation. But, you know, folks out there, whether they are on the long side or the short side of the volatility trade, have pulled in their tenors. You know, the whole 0 DTE, and for people who haven't, who want to read more and haven't seen this piece, my buddy Chris Sidial and his gang at Ambrose Capital have put out what I think is a really good piece of research. Let me see if I can put a link in the chat while we're talking about this.
Thanks for doing that, Jim.
Um,
Because I think I think a lot of the trading public is confused, like we are, about the implications of it. There you
yeah,
go.
so I just
Check
put a
it out,
link in the
guys.
chat for people who want to check out that piece of research. I thought
Okay.
it was very good. You know, you know, the speculation has been people want to believe that this is, you know, the Reddit crowd, the Wall Street bets, you know, retail
Yeah.
speculation. What Chris's research suggests is that there are a couple of things going on. One, you know, if you think, you know, CPI, the jobs data, the Fed meeting, whatever you think might upset the market and you want to hedge that, you know, it used to be that you had to go out and use monthly options, right? Because and then they came up with weeklies. That's better. I can close the gap between the event and my exposure. Well, you know, now you can pick the day and express your opinion as a hedge or as a speculation. And so the volume in short dated options has exploded. Gee, it shouldn't be a surprise. The other thing that's been going on is, you know, the implied on the shorter dated options has tended to be higher. You know, witness VIX 9-day trading higher than VIX. And so people are looking at that and saying, gee, you know, I've been selling vol on a monthly basis and collecting the premium, and that's been pretty good to me. Why don't I do that now instead of on a monthly basis, on a weekly basis? Well, oh, hey, I can now do that every day. And so there is clearly, and you know, is it hedge funds? Is it, you know, CalPERS? Is it sophisticated investors? Whoever it is, there clearly is a short vol trade in the daily expirations. And obviously somebody's got to be the buyer. The buyers in that case are typically going to be the market makers, the dealers. So it's really, you know, we've created a whole new ecosystem of very short dated volatility. The other thing that I think people need to keep in mind, because it clearly has taken some volume away from the S&P options that are incorporated into the VIX calculation. And let's separate the spot VIX from things like VIX calls that settle to the futures, you know, not to spot VIX.
Right.
You know, there's an argument to suggest that VIX has become a little bit suppressed simply because people have pulled in their hedging activity to shorter tenors. And that could very well be true. You know, if you look at volume across expirations, there seems to be a shift, and that may have some impact on spot VIX right now. So, you know, we're in a brave new world. The thing is, if the you know what hits the fan in a real way, which it hasn't yet this year, notwithstanding, you know, what happened in early March, a 0 DTE option as a hedge isn't going to help you if there's a real blow up. You're going to have to go out
every day. How can they, you know,
you can't
have to reposition. You can't do it, huh?
You've got to go out further. You got to go out a week or a month, or
so it's not about the VIX. It's about they're just really in this trading range that we've had in the market. Just are not the elements of volatility. It's a kind of a sideways, dull market, big intraday swings, but when you look at a longer term chart, it's just a big range, and people are writing collars on it, trying to keep it in there, in that box. So I guess we need an event to take it out of, take out 4,800, 3,800 might do it.
Yeah, to the extent that we get a real event, we get people scrambling for longer dated hedges, you could see the VIX and the VIX futures really jump. Is it going to happen? I don't have the foggiest idea.
Yeah, it will, Jim.
You know, I watch it every day. You know,
it's happening now, Jim.
We're kind of in a little narrow range of activity, waiting for something to happen.
Coming out the other side of the hurricane, Jim.
Yeah, you know, so who knows? We'll see. Anyway, let me hit a couple more slides.
All right.
Oops.
So when you start, you have to do this, Jim. You have to promise me when you get tired of covering the VIX that you'll let me know.
Well, I'm going to be around for quite a while, Dale.
All right. Okay. So I'll still be a writer then. Okay. If a guy like you, who's so passionate about an instrument, ever walks away, that's the most contrarian trade ever. All right.
I promise to let you know.
All right.
You know, so here's just a sort of an update of the review I did at the end of the year. You know, so where has 30-day implied volatility traded this year? It's in a narrow range. You know, it hasn't hit 30 yet, and the average year to date, you know, is below the average of, you know, it's sort of tied with 2021. So again, you know, even the regional bank scare and the debt ceiling debate, which we'll come to, you know, haven't knocked this thing out of a pretty tight range yet this year. And you know, interestingly enough, same thing for VIX futures. And I look at VIX futures, I take a constant maturity of 30 days, right, to sort of line up with the VIX. You know, and the challenge with looking at the VIX futures is they do roll every day. And so you know, the only way it makes sense to me to look at it is to create a constant maturity based on the front 2 months. And again, that has traded in a narrow range. You know, we're waiting for something to happen, and nothing has happened yet. You know, realized volatility. One of the reasons that the VIX and the VIX futures haven't gone anyplace is basically the S&P hasn't gone anyplace. Right. You know, realized volatility, I'm looking at 21 days, 21 trading days. So sort of the equivalent of the 30-day calendar VIX. You know, low levels, certainly less activity than last year. Once again, you know, we haven't really seen a breakout in realized vol. And if we don't get a breakout in realized vol, you know, you're not really going to see a breakout in implied volatility. You know, people just aren't scared yet. And maybe they won't get scared. I don't know. Maybe all this stuff is going to sort itself out and we'll just muddle along. Could be. the debt ceiling thing could get interesting. Let's look at the last two historical examples. The one I remember best is 2011.
Yes.
People may or may not remember that, the Republicans took control of the House that year and told Obama, the only way you're getting a debt ceiling deal is if you cut the deficit. Does that sound familiar?
Yeah.
We also had a little Euro sovereign crisis unfold over the summer. But the debt ceiling actually ended up being increased on July 31st. But at the same time, the rating agencies downgraded the U.S. The Euro sovereign thing was still an overhang, and the market just crashed. I remember vividly the first week of August 2011 because we left for a vacation in Europe, and I put all of my client portfolios into 100% fixed income.
This is a very confirming chart to something I read, where this analyst says the problem for the market is not during the process or even, going past the dates. The problem for the markets is when they raise the debt ceiling, because then the Treasury can come in and start offering notes and bonds, and that sucks the liquidity that's finding homes elsewhere out of stocks.
Well,
it's a crowding out effect.
Yeah.
And that tightens monetary conditions when the debt ceiling is raised, not during the crisis phase of it. And that's what you see right there. After they raised it, the market puked.
The market did puke. It was a combination of stuff.
Really interesting.
But it coincided with the resolution of the debt ceiling crisis in 2011. And the simple, and as you point out, kind of a puke of equities. Treasuries actually rallied hard during that period.
Okay, because of the decline in risk.
Absolutely.
What was it, 20%?
Say again?
About 20% decline?
Yeah. I mean, I just did a quick scan there, and it came up with 18%, from, but it was very close to 20, from the July top to the multiple
October
bottoms.
Yeah. Okay.
Yeah. People don't remember.
Slide.
Yeah. People don't remember that we also had a replay in 2013. And once again, in May of 2013, the debt ceiling was reinstated, but there was no increase, and the market puked. You went through this extended negotiation period that saw, two retracements, and then a spending bill was finally passed in February of 2014, but the ceiling was not raised. And, when the market got wind of that, there was another puke. So, do we get one big puke? Do we get several little pukes? I don't know. But, I think people need to be cognizant of the history that says, and to your point before, just resolving the debt ceiling problem does not mean clear sailing.
Yeah. And that's what most will think.
That's what,
a
lot of people,
what the charts say.
That's not what the charts suggest. And again, we could see a replay where, the rating agencies come in and say, well, this is all fine and good that you guys have agreed to raise the debt ceiling. But we don't like
downgrade.
We don't like the combination of increasing the debt ceiling and what you're proposing to do on the fiscal side. And therefore, we think, the credit of the United States has been compromised in some fashion. I don't know that that's going to happen, but again, I think people need to have their trading hats on for the rest of the year rather than, sit back and relax.
Yeah. So you have to be tactical now.
That's certainly my opinion. I think you've got to have a tactical element to whatever you're doing. You need to be paying attention. This is not 2017. We're in waters that may get choppy pretty quickly.
These last two slides, Jim, they're diamonds, and really appreciate the work that you do. And it's exactly what people are not thinking. And that's why it's important to present evidence like this, so that's why I say keep an open mind. It'll keep your account open, right?
I like that. I might borrow that.
You could have it. I'm in a generous mood today. So
and I'll send you the slides.
All right, really great presentation. You have anything else that you want?
I don't have any more. I don't have any more pictures.
Okay.
I think we've kind of summarized my view, which is that there are, and we've still got a hot war in the Ukraine, for God's sake. We've got all kinds of stuff going on. The market tends to try to look past a lot of this stuff, and I understand that. But
I mean, you have pods bubbling on every part of the range.
Right.
There's a pot here, pot there, pot there.
Yeah, we've still got a new guy in Japan sorting out what he's going to do. That could bubble up anytime it wants to. No shortage of bricks in the wall of worry, and markets like to climb walls of worry, but every once in a while they got to either take a breather or the bricks come loose and things come tumbling down.
Yeah, well, I think we'll know in the next month or so if the old saying that in a bull market anything that could go wrong doesn't, and in a bear market anything that could go wrong does. So I think we're going to know, and what kind of market we have for the rest of the year pretty soon.
I wouldn't be surprised.
Jim, really thank you, my trading warrior brother, for enlightening us with a little history lesson of what people would not have expected, but now they're going to be aware of it. And who knows how much money and heartache you saved by bringing those slides in today.
Well, it's always a pleasure to be with you, Coach, and you and your colleagues do great work. I appreciate it very much.
All right. Well, Jim Carroll, everyone, follow him at Vixologist on Twitter. Anywhere else you want people to read your work, or
that's the best place to keep track of what I'm up to. I tend to post there with some frequency. And DMs are open for people who want to get in touch. As long as people are friendly and
no one. I don't want to hear about anyone being mean to Jim. All right.
Coach, I did find out that I had an imposter on Twitter.
Oh, those guys.
Who changed the O in Vixologist to a 0 and was retweeting my stuff and had collected 18,000 followers.
Yeah, I'm always amazed. Yeah, when the pretenders are, doing better than you with your stuff.
Right.
I'll tell you what a bizarro world, huh, Jim? Yeah, no, VIX. Oh, forget the S, Bruno, and you got it. All right, thanks, Jim. Have a great spring, and we'll get back together in the summer, and I bet the picture's different. So
Wouldn't be
That's what I
surprised.
do. I make bets. So
You got it.
thank you, Jim.
All right, Coach.
All right, Jim Carroll, everybody. Could join the team in 18 minutes. They're thanking you, Jim. Everyone enjoyed it. And for the Morning Edge. And I'll be here live tomorrow for the NFP. The whole team will be here. So you be here because the NFP means no frickin' problem. All right. See you, Jim. See
Take care.
everybody. Adios. Don't just count your pips, count your blessings.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.